All right. So in this week's news, there's really a lack of news that's happening right now surrounding the markets. You've got the doldrums of summer. They're here. We hit the first day of summer, was it last week? And we're going into the last week of June. There's a lack of news that happens at this time frame. And the fact that we do have July 4th holiday next week too, we're really not going to see that much news coming out until after the 4th of July. Micron is probably the biggest story we got going on. We have earnings coming out from Micron this week. That's what you're going to hear a lot about from the talking heads. And like I've also mentioned before, and I'll mention it again right now, holidays are typically seasonally bullish for the markets. July 4th is no exception. This is probably one of the most seasonally bullish timeframes when you look at all the U.S. market holidays. And so if you take a look at where we are now, last week of June, going into the first week of July, typically this is a bullish pattern. It's already started off pretty well as of today, all right, as of Monday, June 24th. So you could look at that holiday, and it's typically seasonally bullish through the 4th of July. Now, that means that more than likely going into the 5th is going to be that last day. We'll talk about that here in just a few minutes. Let's go ahead and take a look at our charts and see what we got happening here over this week. So SPY. Now, what I'm doing with the charts this week is I am using some swing trading. I'm using Elliott Wave. And as you can see here, Elliott Wave is just a contrarian form of looking at the markets going all the way back to the end of November. You can see here on the chart, I have these lows in the S&P. We've just seen really higher lows and higher highs. And that has come out of the end of October, beginning of November, where the highs came up to around 525. We had a 33% pullback in April, not 33% of the entire asset, just a 33% pullback from this move right here that happened from November through April. 33% of that was given back. And then we started that run back up again that has happened into even last week. So where do we stand right now? We may have come dangerously close to the bottom of the target here. If you look at last Thursday, we were up very close to 550 on the S&P 500 SPY, and sitting around pretty close to it now. But our target's still the same. We're looking at 550 on the low to 580 on the high, and we're looking at that all the way through summer into fall. That's for the S&P 500. Now, let's go ahead and look at bonds. Bonds are kind of telling a different story. And the story that bonds are telling right now is even though we've had a run up since at the end of April through pretty much the present, bond traders are looking at this, at least contrarian bond traders, looking at this as a setup to potentially run back down again. I'm going to tell you in a minute or two what I believe could start this catalyst. But as of right now, we've seen the bond market go from about 87.50 up into the low 90s right now. I would say getting out of the next 2 weeks, if we're still in this area, then I believe the bond traders are not going to see new lows anytime soon. We could just kind of move into that drifting up scenario. But as of right now, the contrarians see this turning and moving back down, and somewhere around 82.5 to 87.5 for TLT. What does that mean? That means that interest rates could stay persistently high. That we could even maybe see a notch higher. The economy is doing really well. And, we've had these potential rate cuts come off the table. And now we're down to maybe one rate cut by the end of the year. And they're saying that rate cut could come late in the year. They started with September, could even potentially be later, could even potentially be taken off the board. Time will tell. But this next chart, I haven't shown this in a while. This is cash. This is the UUP. This is the Invesco Double US Dollar Index. Now, what this does is that this tracks the US dollar against a basket of foreign currencies. And what we're looking for here is that it runs double the speed of the US dollar. That's why they call it the double dollar. And so you can see what's happened for the year. This is actually up quite well. I mean, at the beginning of the year, we came in around 27. And now we're up to around 29. Now, again, this is cash. This isn't going to move like a stock. but it's still moving quite a bit higher. And if you look at 27 to 29, that's probably a good 7% higher now than where we were at the end of last year. We're on track to get up to around that plus or minus, that 29, let's call it 29.60 to 30.30. So an average of 30. Those were COVID levels. All right, those were COVID levels, and we did see those levels get close to getting hit last year when we had rate hike after rate hike. Right, this is not good for the stock market. If we see this continuing to move higher, eventually it's going to push some negativity into assets like stocks and into assets like commodities. But we're keeping an eye on this one. And again, I think there's a very important date that's going to push this either higher or cause it to break down. And I'm almost there. All right. USO still in this this bullishness. And boy, we've in the last couple of weeks, we've seen USO go from 70 up to around 80. All right. It was at 79.36 earlier this morning when I snapped this chart. And we have that 82.50. All right. That's the highs that occurred back in April. 82.50 being hit here in the next couple of weeks. Why am I interested in the next couple of weeks? Because we run to the end of the bullish seasonality pattern by mid-July. So that's the target we're looking at. Hey, if we bust above 82, then 85 is the next round number for USO. All right. Gold. So gold is really just been kind of moving sideways since April. We hit that high at 225. All right, that was that big institutional push that happened. Since then, we've had about a 27% pullback from the highs earlier this year. So we've seen that come in. That clocked in by around sometime in the beginning of May. Since then, we've gone back up and we've hit that high. We actually closed above the April highs at around, I want to say around the end of May. Since then, we've kind of pulled back and we're sitting closer to the support levels. Support levels around 213 than we are on the resistance levels. And again, I believe that something in the near future is going to cause a change, either push this much higher or push this below the support. But right now, we're seeing a lot of the bigger symbols. All right, SPY kind of slowing down. TLT is trying to get an idea and see if it's going to move lower or if it's going to continue to persist higher. USO's been moving sideways with a bounce. GLD's been moving sideways with a little bit of a drop. Only the cash market has been really kind of trending higher. So all eyes turn to July. This is what I wanted to summarize for you on the on stocks, bonds, commodities, and more commodities. And so all eyes turn to July. July 5th is going to be our employment data, right? That's going to come out. That's coming out after the 4th of July holiday. So considering this is after the holiday, I expect this to be a higher than average volatile day. The reason why? Most people are taking the 5th off as well. A lot of folks on Wall Street are not leaving for the Hamptons the afternoon of the 3rd and then coming back to trade the markets on the 5th, only to go back to the Hamptons again that afternoon. I don't think that's going to happen. I think we're going to see volumes drop on July 5th. And if we have any kind of a report that's even whiffs of much higher than or much lower than average hourly earnings, much higher than or lower than on the employment data that we see, then we could see a pretty volatile day on July 5th. We'll talk about that next week with our next video. But I can tell you right now, that's not a typical day that I want to trade. I'm going to be one of those folks that's going to take that day off from trading, just because I don't want to be a big fish in a small pond. I want to be swimming around with liquidity. And so I'm going to end with that. We want to be, again, smaller fish in bigger ponds when it comes to the stock market, when it comes to, not just indices, but individual stocks themselves.